Hi there. I'd like to welcome everyone to our webinar, Macro Hive webinar. My name's Bilal Hafeez. I'm the CEO of Macro Hive. We like to, every now and then, host a webinar on an interesting and meaty topic. And on this occasion, we're hosting this webinar where we'll be talking about the new COVID relief bill that President Joe Biden has introduced in the US. And then, importantly, we're also going to discuss the nuts and bolts of how the US is exactly going to fund this new spending effort. In particular, we're going to talk about the TGA balance on the Fed's balance sheet. In order to answer these and to talk about these subjects, we have two great speakers today. We have, first of all, Dominique Dwor-Frecaut, who's a senior contributor to Macro Hive. She's also a top economist based in California. She's had all the big jobs. She's worked at the Fed. I think she's worked at the World Bank. She's worked at various hedge funds, including Bridgewater. So she'll be talking about the economics of the COVID bill. Then we have George Goncalves. He's a regular contributor to Macro Hive, a well-known personality in the rates world. I've had the pleasure of working with him when I worked for Nomura as well. George has had various head of rate strategy roles at banks, most recently at Nomura, and before that he, I think, was at Morgan Stanley, and he'll be talking about the nuts and bolts of the TGA and the Fed's balance sheet and how the financing will happen. And before we jump into the presentations, I just wanted to just give you some background on Macro Hive. So Macro Hive, we've been around now for about a year and a half. We set up Macro Hive in the summer of 2019. We've been going strong ever since. And the basic philosophy of Macro Hive is to deliver high quality research to as big an audience as possible, for it to be fact-based, research-based, and for us not to get too caught up in the latest memes and fads. So it's very kind of rigorously done. And we've got a global audience. We have subscribers from all over the world. And let me actually quickly share my screen to show you something about Macro Hive. First of all, let me just go to the website. If you just go to the Macro Hive website, so macrohive.com, you can just sign up to get onto our free mailing list. So you just put in your email. So let me just put in this guy. I hear he's quite important these days, Joe Biden. If he clicked on this, then he'd start receiving our mails. And then as for the site itself, this is our current site. Some of the content you can see, we've got this piece written by John Tierney. He's a credit strategist. He's talking about Biden's infrastructure plan, and he talks about which ETFs you should buy. So he argues in this piece that clean energy and those sorts of ETFs have already priced a big infrastructure bill, but traditional ETFs or infrastructure ETFs have not. We have this piece on how to measure Chinese growth using provincial data. We have this piece here written by John Butler and my partner, Andrew Simon, where he talks about Tesla buying Bitcoin. We actually wrote about this subject last summer. We have something on US house prices, and you can scroll through the site and kind of see more about all of that. You can subscribe here. You just put in your details, and then you can get a 1-month free trial. And then after that, it's just the cost of a few weekly cappuccinos. So it's well worth it. People call it a hidden gem. You can cancel anytime as well. But if you really do want to raise your game in the investment world, then I'd recommend you to subscribe to Macro Hive. So we're going to jump into the presentation. The format today we'll have Dominique Dwor-Frecaut. She's going to talk about Biden's bill, what it means on the economic side, growth, inflation. Then we'll go to George, who'll talk about the financing side. Then we'll have a Q&A. There's a Q&A button in the Zoom window. So if you just post your questions on there anytime during the thing, then I'll pick out the questions that are most popular or most interesting. Then I'll pose those questions towards the end. Now, of course, the Wi-Fi may go down at some point, so just be wary of that. My son is currently on the Xbox, so that usually causes some interruptions to my Wi-Fi normally. So if that happens, then just blame Fortnite for that. But without further ado, let's kick off, and let's start with Dominique, who will be talking about the macro side. So let me just get her slides up. So over to you, Dominique.
Hi, Bilal. Thanks very much for the kind introduction. So what I have to say today is very simple. It boils down to two things. First of all, the Biden plan is not targeting COVID, it's targeting the November 2022 midterm elections. And second, the Biden plan might just be successful from an economic perspective in raising growth and employment very fast while keeping inflation in the Fed comfort zone. So let's start with talking about the plan itself. Next slide, please. Okay, what I'm showing you here on the left-hand side is the scoring of the plan by the CBO. The CBO is a non-partisan organization that costs all the laws that come out of Congress. So there are three things about the Biden plan that are striking. It's surprising, it's large, and it's untargeted. Now, it's surprising because for those of you who followed the inauguration of President Biden, he used very strong language in his inauguration speech, talking about uniting America. And on that basis, it was reasonable to expect him to follow a bipartisan approach to his stimulus plan. But actually, he did just the opposite. He de facto ignored a proposal from 10 centrist Republican senators to go for a much smaller plans than what you have here, which is a 1.9 trillion, of which only 1.3 trillion can be spent in this fiscal year. So really big discrepancy between his professed aim of uniting America and the way he went about getting the stimulus done, which is using a procedure called reconciliation, which basically allows him to get the plan across without Republican support. So he had a choice between a smaller plan with bipartisan support or a much bigger one with no Republican support, and he went for the latter. So that was really surprising. The second thing about that plan is that it's large. I mean, look at how much the US has spent on COVID relief. I mean, about before the Biden plan, about $3 trillion. We are talking about serious money here. And, you know, it's the plan is another 1.9 trillion, of which 1.3 trillion gets disbursed this year. And when I say disbursed this year, it's basically over the second half of the fiscal year, so over April, September. So we're talking big money here. And just to give you a sense of how big, on the right-hand side, I compare the deficit in 2009, so during the GFC, at the thick of the recession, and the output gap, which I have shown in positive numbers on that slide. And then look at the size, the relative size of the two bars for this fiscal year. So it's completely out of proportion. And that's why economists like Larry Summers, Olivier Blanchard have been talking about inflation making a comeback. And one last point about the plan is that it's really untargeted. I mean, if you go to the table, you can see that there are about 400 billion in a one-off payment to household, and everybody is going to get money. Basically, the way the plan has been set up is that couples making up to $200,000 a year are going to get money from the government. So why? In my view, there are two explanations, a big one and a secondary one. And the big explanation is basically the electoral calendar. The US has a very short electoral cycle. Next slide, please. So the next election, it's a midterm, what we call the midterm. It's in November of next year. And all of the 435 House seats are up for renewal, and 1/3 of the Senate seats are up. Now, the problem for the Democrats is that typically in midterm elections, the party of the president loses seats. And the thing is, this time around, the Democrats don't have many seats to lose because they have a majority of one in the Senate. Actually, the Senate is split 50-50, with the vice president casting the deciding vote. And in the House, they have a majority of only 10 out of 435. So they are really vulnerable. And it's a little bit early, obviously, to talk about the November election, the November 22 election. However, what we know is that the Senate, based on the presidential elections, the risks seem roughly balanced at this stage between Democrats and Republicans. So the Democrats might just hang on to their razor thin majority. On the other hand, the House is going to be much tougher. And that's because over the next 2 years, so in the lead up to the midterms, we're going to have redistricting. The way it works is that every 10 years, the US has a census of its population to make sure that the 435 House seats are spread across the country in a fair manner. So based on population changes, you have changes in electoral districts. And the thing is, in most states, those changes are decided by the legislature. And the majority of state legislature are in Republican hands, which means the redistricting is very likely to play against the Democrats. So in my view, that explains the size of the plan, which is really completely out of step with what would be needed for simple COVID relief. It also explains the large untargeted transfers, because these are actually very popular with households, with voters. So that's one reason. That's, I think, the main reason. And there is a secondary reason. Next slide, please, which I think could be, an agenda, certainly of the Treasury Secretary, one of the brightest economists of our generation, knows the US economy better than most. And she said in the past that one of the advantages of running a high pressure economy is that it improved a lot the economic prospects of people at the bottom of the income distribution. Basically, it becomes easier for uneducated people, minorities, to find jobs. And also, the low wages tend to increase more when the labor market is tighter. By contrast, people at the top of the income distribution tend to have faster increases in wages when the profit share is increasing. Basically, their wages are more tied to the evolution of profits. And when the labor market is tight and employers have to pay more for labor, the profit share tend to grow more slowly. So that could be a secondary goal of the administration, reducing inequalities, lifting those at the bottom by running a hot economy. So what this means is that the huge fiscal deficit we are likely to see this year, we are going to see this year, about 14–15% of GDP, is likely to be followed by another substantial deficit next year, perhaps not 15%, but I could see it easily in the double digit. And that's for a very simple reason. If you want to win the midterms, the last thing you want is a fiscal cliff and a slowdown before the midterm. So my expectations is that we're going to see a huge multi-year infrastructure package that will be voted through reconciliation in the fall. So voted without Republican support, and that will be front-loaded to ensure that the economy remains hot ahead of the November 2022 elections. Next slide, please. Now, how hot? Here, I am going to ask you to trust me, and if you don't, we can always come back on the details. But I actually think that we will have a very fast closing of the slack in the labor market, but with limited inflation. And let me give you a flavor of what it could be. Next slide. So let me explain why, despite this absolutely enormous fiscal policy impulse that we are getting, I see inflation remaining within the Fed comfort zone. And that's because of the K-shaped recovery, which means that labor market slack is unusual relative to the economy-wide slack, so relative to the output gap. And the reason is that basically, because of the pandemic, the structure of consumption has changed. Households are consuming a lot more goods. So on the left-hand side, here, this is a blue line that is showing goods consumption in real terms. So you can see that the recovery has been well above the pre-pandemic trend. And by contrast, the consumption of services has been much lower. And we all know the reason. It's because, like Bilal's son, you can very comfortably, play with your PlayStation or keep yourself busy with your PlayStation from home. It's safe. You can order it over the internet. While a lot of services, especially the low value-added labor-intensive services, have not recovered because we don't want to catch COVID. We have restrictions on those services and so on and so forth. So we've had a much stronger recovery across the economy than in the labor market. And the recovery we've had has been concentrated in the goods rather than the services market. And one last thing I want to point out to you, which also explains why we have this enormous labor market slack, is the productivity gains. Look at the the difference between the space between the blue and the black lines, which is basically the increase in productivity that people are consuming. So firms are producing a lot more goods without really increasing employment much. While by contrast, you can see much less of an increase in productivity in the services sector. So all this goods consumption has increased employment by much less than in the past. And so in my view, that's what Summers and Blanchard are missing, that the relationship between the output gap and labor market slack has been completely distorted by the nature of the recession and the recovery. And that's what I'm showing you on the right-hand side, where I'm showing you the budget deficit, which is a blue bar, so the output gap, the spare capacity, which is an orange bar. And then I've added some little red dots that are my favorite measure of labor market slack, which is not unemployment, but the employment to population ratio, which I think is a better measure than unemployment because it takes into account participation. And participation has collapsed. And so you can see that last year and this year, the distance between the red dot and the orange bar is much wider than usual. And this is this K-shaped recovery impact on the labor market. And so, in my view, this makes for a fairly benign inflation scenario. Next slide, please. So here I am showing you a scenario for a recovery in the employment to population ratio and the associated increase in wages. So based on this enormous stimulus, I expect a very fast recovery. In fact, I believe that the employment to population ratio could easily go back to its level of before the financial crisis, and proportional recovery in wage growth. And as a result, this would bring PCE inflation, core PCE inflation, in around 2% by the end of this year. So it would cross the 2% threshold by the end of the year, and maybe rise to about 2.75%, possibly a little more by the end of next year. And I would argue that the Fed would feel comfortable with this inflation trajectory, especially if it was accompanied by an acceleration in growth in wages and even in the income share of labor. In fact, I am prepared to bet that if this is a profile of employment and inflation recovery that the administration managed to pull off, it will be very successful in the November elections. So just a quick word before I conclude on money growth and on why I have such a benign inflation outlook, even though we've had an absolutely enormous increase in money growth. And it's basically for two reasons. The first reason, as you can see on the left-hand side, is that since the mid-1990s, money growth has decoupled from inflation. And in fact, we've had a long-term trend of declining velocity of money. The second reason, which is on the right-hand side, is more specific, is that if you look at the sectoral distribution of the increase in money, it's largely high-income households that have a high propensity to save. So I am betting that a good chunk of the increase in money is going to end up invested in financial assets, maybe in real estate, rather than spent. And the other sector where you've seen a big accumulation of money is non-financial businesses. And what how non-financial businesses spend is by investing and hiring people. And in the short term, this will increase demand, could put a bit of pressure on inflation. But in the long run, of course, this increases the supply capacity of the economy. So it's not inflationary in the long term. Now, before I conclude and I hand over to George, I'd like to list a couple of risks associated with my very rosy picture of the world. Obviously, the impact in labor, an increase in labor participation is key to my story. If labor participation increases, we're going to have both an increase in the demand and in the supply side of the economy, and that's what will make for non-inflationary growth. The second risk is basically corporate sector leverage. As George is going to explain shortly, there is much upsides to yield. This is going to increase funding cost for the corporate sector that has piled up a lot of leverage. I don't think it will be an issue because the increase in yields will take place in the context of faster growth. And then the midterm elections. If the Democrats lose, we're going to have a very big fiscal cliff. We're going to have austerity from a Republican-dominated Congress. With this, I would like to hand over to George.
Thank you, Dominique. I'll pick up where Dominique kind of left off and think about how is the U.S. government going to fund this massive stimulus that Dominique just went through. I'll start off with focusing on, luckily for the U.S. in this current administration, the prior administration has left a large amount of cash at the Treasury's general account, which is warehoused on the Fed's balance sheet. And but at the same time, that's not going to be enough, and there's going to be a need to really term out the debt and actually just borrow more just to fund both the ongoing deficits, the additional stimulus, an infrastructure plan. We're starting to talk about some really big numbers, and one of the potential risks that, as Dominique mentioned towards the end, is what happens to the cost of funding, and does that become like a short circuit that actually makes it harder to really sustain this sort of momentum that was being described by Dominique. So maybe if we can turn to the first slide, where for those that are not familiar, this is a chart of what is known as the Treasury General Account. It's the TGA for short. And right now there's a little bit around 1.5, 1.6 trillion sitting there, as you can see with the blue line. And you can notice that prior to the pandemic from 2000 and prior, you can see that that cash that was sitting at the Fed was basically oscillating between sometimes it would go down for debt ceilings, which we'll discuss in a moment, and somewhere between roughly averaging 300 plus billion. Now, right now, what we heard from the current the new Treasury plans at the most recent Treasury refunding, they're calling for the first target of using this cash to go basically get cut in half. Just basically the bottom line really is what speed will the Treasury be able to spend this? And a lot of it's dictated on when we get the passage of this stimulus. I mean, there is enough of an impetus and big enough deficits running anyway that if they decide to issue less T-bills, they can start using this cash faster. But they have to then start to balance out market implications and things like that. And number two, although this is a much more credible plan, and we do have a majority down in DC, and that you would assume would fast track this much quicker. Last year, there was a lot of tensions, and this money could have been spent last year and it wasn't. So we'll see if they hit their target. I mean, the target for March 31st, basically we got 6 weeks or so to hit the 800 billion. I'm a little bit skeptical they're going to hit it, but we'll just take them at face value. And then the second target by the end of the second quarter is somewhere around 500 billion. And this is a lot of additional stimulus and cash that's going to be entering the overall broader financial system, let alone obviously making its way to those that need it for relief. But at the same time, it's just a lot of liquidity that we've never really experienced this massive swing in the TGA. So I think that's it's an important starting point. Let's now maybe move towards the next slide. So this isn't a historical window looking back at the TGA, again, but now on a 6-month rolling basis, which is the orange line. And then the blue line is the 6-month change in outstanding Treasury bills, the short-term treasuries. As you can see, there's been moments where we've seen some swings in the past as well, nothing as big as what potentially that lies ahead of us. But I think it's important to call out to try to understand, and this might help investors and those that have experienced these changes around the debt ceiling, and looking at what took place then, and then what would happen as the U.S. government would replenish the TGA. This is going to be really in one direction, cash going out, and in theory, it's going to cause an issue for short-term rates. We're already seeing short-term rates starting to head towards the floor or zero in that sense, and it's also potentially going to just change investor behavior around things when it comes to money markets and potentially terming out and buying longer-term treasuries. So I just want to show these charts. They look extreme, and they are. It's really these are large numbers that we have not really experienced. We're only in the early innings of this. It's mid-February. By the middle of this year, this sort of movement should leave a pretty big footprint in the markets. And what I'd like to kind of move on to next is to think through, what exactly, does that mean? Like what happens when the TGA is drained this quickly, or we see big movements like this. So if we move on to the next slide, we'll look at, this chart, which looks at bank reserves. What I'm showing you here on this chart, this is looking at the bank reserves relative to the deposits at banks. And then the gray line is basically the cash to deposit ratios. The reserves are treated as a cash asset for the banking system. And what we saw through 2015 through 2018 was two forms of reduction in reserves, partly for new programs that were being put in place, and also the Fed's QT. And long story short, last year you saw that pretty big spike before the gray estimated line. You see a pretty big spike higher in reserves to over 3 trillion. And if this were to happen in the way that I described, we're talking about potentially almost nearly a similar experience of what happened last year reoccurring in the next 3 or 4 months, of an order of similar magnitudes, which would push up reserves to 5 trillion. And this will have an impact on a variety of things, most likely starting out soon enough in the short-term rates markets. But it does push up, as you can see with the gray line, if all of this cash makes its way towards reserves in the banking system, the cash to deposit ratios are going to get very close to their prior peak, which was in 2013 during the QE3 period. I bring up this point because I think it's an important point. Although the Fed is in no rush to taper, and most likely would probably allow this if this were to happen this way, would allow this to continue in the hopes and aims of aiding the Treasury and overall U.S. expansion to continue to achieve these targets that Dominique was mentioning around growth and inflation. At the same time, though, I think they're going to be cognizant of the fact that at some point there's going to be a lot of reserves in the system if they don't either drain some of those reserves or start to slow down QE. In other words, when do they start to taper? And so I think this chart is one of the most powerful charts out there to kind of keep an eye on. If this is exactly how it works, then at some point we're going to have a lot of reserves in the system and they're going to address it. Now, what we saw yesterday from the Fed's minutes from the January meeting, they're looking to rely upon the traditional tools like the interest on excess reserves, the IOER. They could potentially raise that rate to try to keep this sort of experience of short-term interest rates trying to go towards zero and try to bump them up through that channel. They can also expand the reverse repo program, which is, I think, one of the things that's probably also not understood by most market participants. And so if we turn to the next slide, Bilal, what I'm showing you here now is, instead of the level, which was in the prior chart, this is looking at the annual change of reserve growth. And I put out the idea that the TGA wildcard is what we don't know how exactly the TGA cash will go into the system, and then what do money markets do, and where do they park their cash, and what does the Fed do with the sort of constraints that are in the RRP program. It's a lot to go into. We don't have to go into it now in detail, but the bottom line is the truth is probably somewhere in the middle. So I'm showing you in the gray area towards the right of the chart a estimation of reserve growth with a full unleashing of the TGA cash going into the reserve side of the accounting, and that would push up annual growth of reserves, over 2 trillion, and that's massive. It's more than what we saw last year. Or alternatively, somewhere in the middle, or if there's an absorption of those reserves through the reverse repo program, that could at least kind of provide some sort of buffer there. So I think this is an important topic. I'm happy to take questions on it later on, but this is really just describing the next 3 to 4 months. It's going to be coming at us very fast. It's going to be a lot of moving parts. I think we're starting to see the dots connected around what it means for short-term rates. The Fed's going to, it's conceivable that the Fed might have to raise IOER rates in the March meeting, maybe sooner, we don't know, but I doubt they want to come off as sounding like they're panicking. So they're going to try to hold off as long as possible, or to really try to downplay this technical adjustment as something just to deal with the plumbing. Either way, though, that sort of message, I think, is something markets should be watching. The last time the Fed did a technical IOER adjustment was at the January meeting in 2020, and 2 weeks later was the peak in the equity markets. Now, I'm not suggesting that was anything to do with it, but at the same time, the plumbing matters. And if there's a huge expectation of additional liquidity coming in, and if the Fed actually has to mop it up, otherwise things get out of control, it could be a source of contention. So I think it's important to watch. It's going to change the way that the government finances itself in the short run. It has market implications for short-term interest rates. Now, what does it mean? How will let's move on now to the next 2 slides, where I go over how will the U.S. government finance this debt, because they cannot rely just on short-term cash usage or T-bills. And what we've seen historically, as this next chart shows, with the black line, which is the annual change of the Treasury notes, which is the longer-term Treasuries, which is the primary vehicle for most of the funding, although they're also issuing a lot more 20-year and 30-year bonds, but the majority of the issuance still takes place in the 2 to 10-year sector of the Treasury market. And what I'm showing you here is the annual change that took place since 1997, and you can see that it kind of goes in waves as fiscal stabilizers come in around recessions. The government spends more. Then at some point, the government terms out its debt, and we saw that in 2009 through 2011. And now we're seeing a similar situation happening here too. And I juxtapose that with the Fed's annual purchases of that same sector of the notes program. And we can see that there was no period, even during the heights of QE1, QE2, and QE3, there was no period back then where the US, where the Fed was buying more than what was being issued in the US. Contrast that to what happened last year around their reaction to supporting market function and getting volatility under control. They bought significantly more than what was being issued in this sector, as well as in other parts of the Treasury market and TIPS as well. What I'm showing towards the end is that there's going to be a point where, because the U.S. is going to be terming out its debt and no longer just relying on short-term debt and relying more on long-term debt, unless the Fed starts to increase its purchases, which would be inconsistent if the economy is growing, at some point they're going to fall behind, and there's going to be more long-term debt being issued than what the Fed is buying. So this is an important piece of the puzzle, which I think will continue to support, my overall thesis of how rates are going to evolve for the balance of 21 into 22. If we move on to the next slide, this is that same chart, but I dropped off the Fed's annual activity, just focusing strictly on the supply factor of the annual change, which is that black line again. And I've now compared it to the Treasury curve and as well as term premium. And I note where we currently are, somewhere around 120 basis points. In prior periods, and this is where it gets very tricky, considering where we're starting from, because starting points really do matter. The Fed, traditionally in the past, coming out of recessions, used to have a lot more bandwidth and flexibility to cut rates and steepen out the curve through the short end of the curve. Now we're at a point where most of the curve movements are being done by long-term rates rising in anticipation of inflation, in anticipation of more supply, and also because globally other regions are doing similar sorts of fiscal measures to try to get their economies revived again. So we have a really global rates backdrop of which we have not had in decades, where this is now the point in time where if there's any chance for higher rates, it's really now or never, in my opinion. So we've seen a lot of this movement already. We've seen the curve steepen in a big way from the lows and also rates rose from the lows from last year. And we've seen term premium really move from that point in August of last year till now. The question is, how much steeper can we go? And will it be just a kind of linear kind of format? My view, in which I'm happy to take questions on, is really it's going to be a two-stage process. Nothing goes up in a straight line. Even in the 2009-2011 period, had an initial large steepening, consolidation, and then further steepening. So I think a two-stage type sell-off would be consistent with, we're going to see how the recovery actually takes hold in the second half, and then anticipate all the supply that's coming, which I forecasted in these two slides. I think that's what lifts us up towards 175, 2% on the 10-year, and then we'll see if we can, if A, we get there, and B, can we stay there? So with that, I'll stop and put it back to you, Bilal.
Great. Thanks a lot, George, and Dominique, both of you. That was really, really very helpful. We've got a bunch of questions from the audience, and everyone feel free to, write more questions if you have a question. Just for clarification on my side, George, I just wanted to clarify a few points on the TGA and its relationship to short-term rates. So what you're saying is the TGA balance is very, very large right now, and that has been essentially pushing down short-term yields. Is that kind of a fair characterization?
Well, the usage of the TGA will push down short-term yields. At this very juncture, there's still 1.6, 1.5-ish trillion. As that money is dispersed and they become reserves in the system, as kind of cash gets dispersed throughout, it's going to put pressure on short-term rates because there's going to be a lack of collateral. So that there's going to be more money in the system. It's going to be pushing down and demanding interest rates to come down. So it hasn't happened yet. It's
okay. So once we get this transition from the TGA balance towards reserves, that will start to push down short-term yields.
And the market's pricing some of that already.
and the market's obviously anticipating some of that. And then so the Fed therefore then has to think about, okay, how do you kind of get rates back up? So they might do something on the IOER. So that was kind of just one point of clarification. And then the other one was in terms of the curve steepening. The last chart you showed. If you look at sort of the previous peaks, the curve has kind of steeped to 250, 300. You kind of alluded to something right at the end there around, the 10-year is doing all the work right now rather than the front end. So it's kind of a very clear sort of, back end's kind of steepening. What scenario would you need to see for the curve to steepen that much to 250, 300? Can it really all just come from the 10-year?
No, I think you would need to overall have a reassessment on the outlook for rates in general, and really the Fed and inflation having to be running at the levels or beyond what Dominique described, and doing it for more than just 1 or 2 quarters. We're heading into an environment where the base effects are going to most likely signal that there's higher inflation, plus there's going to be a backloading of more inflation into 2022. If it's sustainable and the market's pricing that in, we'll see if we can get towards 250. I'm not there. I think that if we get to 175, 2%, it's a big number, and I think the Fed is also watching it from that vantage point too, because one thing which we have a chance to discuss, which is what's the Fed's reaction function to all this. And at one stage they want to champion the higher inflation. They also don't want to raise rates. They don't want to stall the recovery, and they're really kind of fighting two sides of the curve. And that's arguing many to suggest that they're going to have to do yield curve control. They're not there yet, in my humble opinion, but they also then have to figure out, do they taper? So it's a very confusing period, and I think they'd rather just wait and see. And that's going to probably mean that the 10-year does all the work, but there's going to be a point where it gets exhausted in the second half. Yeah.
But there's kind of a few more questions. I mean, one was, could short-term yields go negative? Is kind of one related point, George. And there's another one around as reserves build on bank balance sheets, which are already kind of jammed, what do they sell as they kind of take on more reserves? What's the other side of the balance sheet for banks?
Sure. So it's more they're going to be able to purchase other treasuries with it. It's going to be just a lot of additional liquidity looking for short-term assets in a compressed window. If we do see negative rates, I don't think that there is a decent risk. I will not downplay it. There is a decent risk that we see that for a number of treasuries. There's a number of T-bills that are very close to getting close to negative rates, and I wouldn't be surprised that we see negative rates. The challenge is that the U.S. doesn't issue T-bills in negative rates, so it's going to have to be a zero floor. And so I think we're going to be seeing moments of that in the secondary market. I don't think we're going to see sustained funding at negative rates, but that's something that the Fed is super sensitive about. Obviously, they want to have a command of the Fed funds rate and make sure that it stays at their target range. And that's why that the IOER hike is probably their first port of call.
I think you're picking up a bit there, George. Let's kind of move on to another question. This is more for Dominique. There's a couple of questions. One is on the Asian side. There's a view that supply may erode in the sector. So when demand's unleashed as the economy opens, is there upside risk to inflation?
Okay. Would you like me to?
Yeah, so why didn't you kind of tackle that one? And then also kind of a related point is, what are the key domestic metrics you're looking at on this kind of recovery, the strong recovery sort of path in the next 3-4 months?
Okay, so on basically the question on the erosion of supply capacity, that's scarring, right? Whether there will be long-term damage. And I would argue there won't be, in the sense that labor will be available to be hired by people, by employers. Yes, people who have been unemployed the longest will probably get rehired the last. So in terms of their lifetime earnings, there will be a loss. But in terms of labor availability being a constraint to the recovery, I don't think so. In my view, the biggest risk in terms of scarring and constraint on the recovery is bankruptcies. Because with bankruptcies, especially large-scale bankruptcies, you have employers who exit the market. So say GameStop is no longer, well, GameStop is not a big source of employment, but say one big brick and mortar retailers are no longer there to hire people, and it takes time for new employers to either expand their existing capacity or create new businesses that will be able to absorb the surplus labor. But the thing is, we haven't seen large-scale bankruptcies. We have seen a lot of small mom and pop businesses disappear, little restaurants, convenience stores. But those, I think, can come back quite quickly once the recovery is underway. So I really don't buy the story about the scaring. I would be concerned if, for instance, we had huge issues with household balance sheets, because that was, in my view, a key reason why the recovery from the financial crisis was so slow. And in fact, household creditworthiness on average has improved. People have used the stimulus checks to pay down the debt. If you look at indicators of delinquency, they are down. Of course, it reflects in part the forbearance that the government has instituted. But, you know, while there are pockets of weaknesses, I don't think, you know, consumer balance sheets are a big issue. So I'm quite confident on that side. The other question was the key domestic.
Then on the domestic metric, on the metrics, you're focusing on the key metrics for the next few months.
So participation, and also indicators of financial distress, of you know, household balance sheet getting worse, bankruptcies increasing. A key risk, as I said, is that with the debts that the corporates have piled on, once the cost of funding is rising, they may not be able to pay their debt. So I'll also be looking at credit spread very closely. So basically indicators of financial stress.
Okay, great. That's very good. I have another question. There's a couple of questions around this. I mean, what are the risks to this scenario? So this is, I guess, for both Dominique and George. So Dominique, you go first, then we can go to George.
Sorry. So the risks are basically, I mean, the key risk in a way, besides the fact that, you know, participation may not increase as fast as I expect, which is really the linchpin of my scenario. The risk is going to be how you climb down from this enormously expansionary policy. So can you engineer a soft landing? And I agree that it is an open question. I just don't think it's a question for this year or next. So this is my my answer to this.
Okay, yeah. And George, what's your thing? What's the risk to this kind of scenario?
Well, I mean, look, I'm relatively on board with Dominique's outlook. And there's limited execution risk, but there's always some. So I think it is just a matter of timing and how all these cash flows get into the economy, and if it's actually going to work out that way. I mean, obviously we have huge potential for pent-up demand, and that's just naturally happening as the economies hopefully open up, and then you have this added on top of it. It's obviously created a big narrative and a buzz around a really robust recovery. The question then is, the markets are picking up on those signals as well. I do think that we're going to have a two-stage kind of sell-off. We'll see if rates stabilize here or not, and then in the next big rise in rates, what does it do to financial conditions? And so the risk really is going to be channeled through financial conditions, and does that short circuit the overall recovery from a wealth effect and things like that. Now, Dominique obviously knows this better in terms of the multipliers on the fiscal side, but fiscal multipliers are also not known to be the most efficient either. So are we going to get a complete benefit from all this money is also a big risk as well.
Okay, we'll just take one more question because we're almost coming to our time. There's a question about what does this all mean for the dollar? There's a couple of different variations of this question, but what does it mean for the dollar? Maybe I'll kind of start because that's kind of something I look at a lot as well, and then others can sort of chip in as well. I mean, my kind of view is, in essence, what we're saying is that US yields are going up. So, does that make the dollar more attractive? I would say that in general, it should make the dollar more attractive, but there's a caveat. One is that yields are going up elsewhere as well, even in Europe. So if you look at bond yields, they're going up as well. And so in that sense, the relative yield differential becomes important. So that muddies the water a bit. The other thing I would also point out is you have to look at the rationale of why yields are going up. The reason yields are going up is because the growth is picking up and the world's looking better and everything's looking good. So in that sense, that's positive for all the growth sensitive markets in the world, particularly like EM and commodity type markets. So then the dollar question becomes more nuanced, where the dollar could still weaken, against countries that themselves offer high yields like Turkey or growth sensitive markets. But the dollar could do better against, lower interest rate markets like the Japanese yen or the Swiss franc, so even the euro, the dollar could do well again. So you won't necessarily get this broad base dollar weakness. So that's kind of my take on it. I guess a kind of a variation, I saw a question from somebody around this all is, is the Fed focused on the dollar at all or not? Because if we do suddenly go from an environment of a weak dollar, which we saw for the last 6-7 months, to a stronger dollar, that could potentially derail, inflation and so on. So maybe this is more a question for Dominique about that.
Sure, I'll just give the standard Fed answer, which is they are not targeting the dollar, but the dollar is a driver of inflation, and they are targeting inflation. So which is a way to say it will be one argument in their decision function, but perhaps not the main one. Also, if they have the economy going gangbusters, as I expect, they will be probably quite happy to see a bit of a disinflation brought by a stronger dollar.
Okay, no, that's great. And just a related point there for George. Do you think, what do you think of the foreign flows into treasuries? How do you kind of see that evolving in this environment?
Well, I mean, I think at some point, as you described, and we mentioned earlier, this is a global phenomenon. That the fiscal impulse is not just in the U.S. and rates are rising globally, and so there is going to be probably a home country bias in general, and a lot of the banks in the U.S. can take the load of this Treasury issuance, and the Fed will still be buying for a number of quarters ahead. So then it really comes down to what entices foreign investors in, and as we've been watching, FX adjusted yields, even though other global rates are rising, U.S. rates are starting to look even more attractive for European and Japanese investors. So the low yielder regions are going to probably still be finding value in the U.S. bond markets, both in IG and credit and treasuries, whereas emerging markets or the official sector flows into treasuries maybe won't be as strong.
Could I just add on the issue of the dollar, one thing that could push the balance in the direction of a dollar strength is that the US could reopen ahead of other countries. I mean, look at how the immunization campaign is going, look at the electoral cycle I mentioned. Plus, I suspect that when we do the numbers, the US will probably turn out to have the most expansionary fiscal policies of all developed economies. So you could have that as well.
Yeah, that's great. Okay, I think on that note, we can kind of start to wrap up. I'd like to sort of big thank you to Dominique and George for their excellent exposition. If anybody wants to, see more of either Dominique or George's work, then just drop me a message and I can sort of tell you how to get hold of their more comprehensive research. George is also very active on Twitter. He's on @BondStrategist, if I recall correctly. And Dominique, writes, on Macro Hive periodically, and also she has kind of other more detailed research as well, which you can get hold of if you just drop me an email or drop her an email. And once again, just sign up at macrohive.com. You can get free emails there. Also, we'll have a recording of this webinar as well. So we'll put this up at some point with the slides as well. So on that note, big thank you to the speakers and to everybody who listened into this webinar. Good luck.
Thank you.
Bye.
Thank you.